The markets opened on an ordinary Tuesday morning in early 2026. Traders sipped their coffee. Analysts scrolled through overnight data. And then something peculiar began to unfold. Gold pushed past its previous record, not with a violent spike, but with a quiet, relentless bid that refused to fade. By Wednesday, it climbed again. By Friday, the pattern was undeniable. This wasn't a one-day headline, but this was something different, something the textbooks didn't quite explain, because in a normal world, risk assets lead the charge, stocks rally, cryptocurrencies surge, and gold sits quietly in the corner, gathering dust. But this time, the order had flipped. The insurance policy was getting bid up, while everyone else pretended not to notice. Silver, that volatile younger sibling of gold, began stirring from its slumber, moving with that familiar explosive energy, the kind that only shows up when stress and scarcity align at the same time. Financial analysts on television offered their usual explanations. "It's just inflation," they said with confident smiles. "Geopolitical tensions," another expert chimed in. "A temporary trade," the third one assured viewers. But seasoned observers knew better. They knew that gold doesn't behave this way unless something deeper is shifting, something beneath the surface, something the comfortable narratives were designed to hide. Because here's what most people miss about defensive assets. They don't attract sustained flows when everything is fine. They attract flows when trust begins to leak. Not all at once, not with sirens blaring, but with a slow, silent drain that most people never notice until it's too late. In a healthy market, gold yawns. It drifts sideways. It waits patiently in the shadows, playing its role as the forgotten hedge. But when gold starts printing records like a metronome, when it climbs day after day with stubborn persistence, that's not mood. That's migration. That's capital relocating from promises to possession. Gold just refused to behave. Silver just started to wake up. And the quiet part is this. When boring defensive metals sprint to new highs, it's not a celebration. It's an alarm. Because money doesn't hide in gold when it feels brave. Money hides in gold when it smells smoke. So what actually happened? And more importantly, what is the system trying to tell us before it's too late? Welcome to Currency Chronicles, where we decode the language money speaks when words fail. Now, if you've been around long enough to remember when a handshake meant something, when promises were kept without lawyers, then you know that trust isn't built overnight. But it can vanish in a moment. We're building something different here, a community that reads the warning signs before the sirens. So do us a favor, hit that subscribe button like you're locking your front door at night, not because someone told you to, but because you know it's the smart thing to do. And drop a comment below. Tell us where you're watching from, which city, which country. Because this story isn't just happening in one place. It's unfolding everywhere. And we want to know where you're standing when the ground starts to shift. Now, let's get into what the system is actually telling us. From paper assurances to physical certainty. And silver's confirmation made the signal even stronger. Because silver has two faces. One face is money, like gold. The other face is machinery. It gets consumed in solar panels, electronics, industrial sensors, scattered into products that never return to market. When both faces start pulling in the same direction, when investment demand meets industrial tightness, price doesn't just rise. It starts acting like a spring that's been compressed for years, finally slipping off the latch. The financial historians studying this moment years from now would mark this period carefully. They would note that the warning came early, that the system spoke clearly, but most people were too busy watching the noise to hear the signal. Because gold is not just a metal, it's a lie detector for the entire financial system. When gold relaxes, it's telling us the system has room to breathe, room to normalize interest rates without breaking anything, room to reduce debt without causing chaos. But when gold tightens its grip, when it refuses to let go, even as policymakers insist everything is under control, it's saying something entirely different. It's saying the room is smaller than advertised. The margins are thinner than reported. The options are fewer than promised. And here's what makes this moment particularly significant. Gold doesn't need permission to exist. It doesn't need a central bank's credibility, a politician's promise, or a company's earnings report. It just sits there, final settlement, like a fire extinguisher mounted on the wall, the one you pray you never need to use. So when everyone starts buying fire extinguishers at the same time, when the quiet accumulation becomes a persistent bid, the question isn't whether something is wrong. The question is, what do they know that the headlines aren't saying? The market was speaking in the only language it couldn't fake for long. Price behavior under stress. And the stress wasn't coming from panic. It was coming from arithmetic, from numbers that no longer added up the way they used to, from a system built on assumptions that were quietly becoming liabilities. The first phase of any major shift always looks like this, subtle, dismissible, easy to explain away with comfortable stories. But those who understood how systems break knew better. They knew that cracks don't appear on the surface first. They appear in the foundation, where nobody's looking, until the weight becomes too much to bear, and the weight was growing heavier by the day. Because beneath these market moves lay a structural problem, one that made every policy choice a trap, every solution a new problem in disguise. The debt architecture was about to reveal its true nature. There's a mortgage on the kitchen table, not a real one, but a metaphor that explains everything about the moment we're living through. One mortgage is manageable. A family budgets, makes payments, builds equity over time. 10 mortgages in a neighborhood, still fine. The economy hums along, banks are happy, homeowners sleep soundly. But what happens when the entire city is mortgaged? When every building, every street, every park bench has a loan against it? When the future itself has been borrowed against so many times that there's nothing left to claim? That's where the global financial system found itself in early 2026. Not in crisis yet, but in a cage of its own making. The modern economy runs on one engine: credit. More credit creates more growth. More growth creates more stability. More stability justifies more credit. It's a beautiful loop, until the loop becomes a noose, because credit only works as fuel when the future can pay it back. When the future can't, credit transforms from rocket fuel into dead weight, a trailer chained to the back of a struggling truck, and every mile forward becomes harder than the last. Central bankers understood this problem better than anyone. They sat in quiet conference rooms, staring at projections that didn't project well. They faced a contradiction that couldn't be solved with clever policy, only postponed. The system needed lower interest rates to survive the debt burden, but it needed higher interest rates to defend currency credibility. Both couldn't win. One had to lose, and whichever one lost would drag everything else down with it. Imagine a doctor trying to treat two patients with opposite needs, one dying from high blood pressure, the other dying from low blood pressure. And they're the same person. That's the policy bind in plain terms. Raise rates, and the debt service bites. Governments rolling trillions in bonds suddenly face higher costs. Companies refinancing face steeper bills. Banks holding long-dated bonds watch their balance sheets bleed. Consumers with credit cards and car loans feel the squeeze tighten. The system doesn't feel discipline. It feels a weight plate added to the barbell right when the lifter is already shaking. But lower rates. That brings its own poison. Currency credibility starts bleeding. Inflation pressures build. Savers watch their purchasing power evaporate. And foreign holders of debt start asking uncomfortable questions. So policymakers tried to thread the needle, talking tough on inflation while keeping rates just low enough, promising fiscal discipline while spending just enough to avoid recession, defending the currency while printing just enough to keep the lights on. It was a high-wire act performed without a net. And the wire was getting thinner. Every lever they pulled seemed to loosen another wire somewhere else in the machine. Spend more and the debt pile grows unsustainably. Spend less and growth chokes immediately. Tax more and economic activity slows. Tax less and deficits explode. Print more and trust erodes. Print less and liquidity dries up. This wasn't political opinion. This was arithmetic. Cold, unforgiving mathematics that didn't care about election cycles or public sentiment. And when arithmetic starts cornering policymakers, when the numbers leave no good options, only less bad ones, markets don't wait for official announcements. Markets front-run the constraint. That's what gold was doing. It wasn't predicting some cinematic collapse. It was measuring the shrinking room for maneuver. It was pricing the trade-off that policymakers would eventually have to make. Because in a debt-saturated system, there's always a way out. Just not a painless one. The path of least resistance is devaluation, not announced with press releases, but executed through slow motion, through inflation that's tolerated, through currency weakness that's explained away, through purchasing power that quietly transfers from savers to assets. It's the reset nobody declares. The one that happens through 1,000 small choices instead of one big event. And this is why gold's persistent strength mattered. It wasn't predicting apocalypse. It was measuring direction. It was telling anyone paying attention that the system had chosen its path, or rather, that the path had been chosen by the numbers themselves. The debt wasn't going away. The obligations weren't disappearing. The promises made to bondholders, pensioners, citizens, they would be kept. But the value of those promises could quietly shrink. A dollar is still a dollar. But what that dollar can buy becomes the variable. And gold was measuring that variable in real time, converting trust into weight, converting promises into ounces. But the story didn't end with paper money and government bonds. There was another layer to this warning, one that made the signal even more urgent. Because while the debt architecture explained why gold was rising, it didn't explain why silver was confirming the move with such force. That required understanding something the financial models consistently missed. The physical world has limits that spreadsheets cannot override. There's a difference between abundance and the illusion of abundance, a difference most people never notice. Until the illusion breaks, in 2026, that difference was becoming painfully clear in the silver market. and the implications reached far beyond one shiny metal. Silver is strange. It's not quite money anymore. But it's not quite industrial commodity either. It lives in both worlds, straddling a line that makes it uniquely dangerous when pressure builds. Gold gets stored, vaults hold it, central banks stack it, wealthy families pass it down through generations. When gold is needed, it comes back to market. But silver? Silver gets scattered, it gets consumed. A thin layer coating a solar panel in California, conductive traces on a circuit board in Taiwan, sensors in a German automobile factory, medical equipment in a Tokyo hospital. Once it's there, it's gone. Recycling silver from these applications costs more than it's worth, unless prices surge high enough to justify the hassle. So while gold circulates, silver disappears. And in early 2026, two forces were colliding in that small market. Investment demand was rising as the gold signal spread, but industrial demand wasn't falling. The world was building more solar capacity, more electric vehicles, more 5G infrastructure, more data centers humming with silver-laden components. Technology wasn't slowing down, it was accelerating, and every advancement sprinkled more silver like conductive dust into products that would never return. The market was heading toward a choke point, and very few people saw it coming. Because for decades, the financial system had learned a magic trick. It learned how to make scarce things feel abundant. The trick was simple: paper, create contracts, derivatives, claims, financial instruments that represented metals without requiring the metals themselves. On paper, you can create more gold with a keystroke. On paper, you can create more silver with a promise. And for a long time, this worked beautifully. It provided liquidity, let industries hedge their exposure, allowed traders to express views without moving physical metal. But it also created something fragile, a market where price discovery happened among participants who never touched what they were trading, where the weight, the texture, the reality of the metal became abstract, just numbers on screens, promises in contracts, exposure without possession. And that system only holds as long as everyone agrees to keep playing by the same rules, as long as settlement stays abstract, as long as claims remain acceptable substitutes for actual metal. But what happens when the agreement cracks? What happens when more players stop wanting exposure and start demanding possession? In early 2026, that behavioral shift was beginning. Quietly at first, a mining company insisting on physical delivery instead of cash settlement. A technology manufacturer locking in supply with actual metal, not futures contracts. A sovereign wealth fund requesting bars be moved from London to domestic vaults. Small moves, but meaningful ones, because the moment the crowd stops accepting IOUs and starts asking for delivery, the leverage collapses into reality. And reality is not symmetrical. Reality is finite. Reality doesn't care about your financial model or your sophisticated trading strategy. Reality is metal in a vault, or it isn't. The paper market had created an illusion of depth, as if there was unlimited silver available at current prices. But the physical market knew better. Premiums started widening. The gap between paper price and physical price, delivery times stretched from days to weeks. Industrial procurement managers started securing supply months earlier than normal. These weren't headline moves. They were the quiet footsteps of smart money repositioning. And they revealed something critical about the broader system. Because gold and silver weren't just investment assets, they were collateral assets. They sat in the basement of the financial skyscraper. Supporting the leverage stacked above them, banks used them as high-quality liquid assets. Funds pledged them as margin. The entire derivatives market rested on assumptions about their stability and availability. When that collateral feels solid, leverage feels safe. But when that collateral becomes contested, when physical delivery becomes questioned, when counterparty risk stops being theoretical, leverage transforms from wealth multiplier into trapdoor. A bank can be solvent on paper and still get destroyed by a confidence shock. A fund can be mathematically correct and still be forced to liquidate because financing evaporates. The system doesn't break from insolvency first. It breaks from illiquidity. From the sudden realization that what everyone thought was money, what everyone assumed could be settled easily, requires permission, time, and counterparties willing to transact. And in stressed environments, all three become scarce. That's why silver's confirmation of gold's move mattered so much. Gold was saying trust is weakening. Silver was saying, and the physical world is tight. Two different signals, pointing at the same conclusion. The balance between paper and physical was shifting, and when that balance shifts, price behavior changes completely. In paper-dominant regimes, price can be managed, guided, stabilized through intervention. In physical-dominant regimes, price becomes a release valve, pressure-seeking equilibrium through whatever path it can find, and the pressure was building. But there was one more dimension to this story, one that connected domestic stress to global realignment, one that explained why this wasn't just an American problem or a European problem, but a structural problem in how the entire world settled accounts. Picture a highway, not just any highway, the only highway. For 70 years, the world's commerce traveled one route. One currency dominated transactions. One bond market absorbed global savings. One reserve asset sat at the center of every central bank vault. The system worked because everyone believed in the fairness of the road. Not perfect fairness, but predictable fairness. The rules were clear. And more importantly, the rules felt neutral. If you played by them, you got access. If you saved in dollars, your wealth was safe. If you needed liquidity, the market was deep. The highway felt permanent, like infrastructure that would outlast generations. But in 2022, something changed. Russian foreign reserves were frozen. Not because Russia ran out of money, but because access to the highway became conditional. The world watched, and the world learned. Safe assets, it turned out, weren't entirely safe. They were conditionally safe, available when the system approved, restricted when the system didn't. And once an asset becomes conditional, it stops being a pure reserve. It becomes a geopolitical instrument, a tool of statecraft, a weapon that can be deployed. The lesson echoed through finance ministries from Beijing to Riyadh to New Delhi, not with angry speeches, but with quiet policy adjustments. Diversification wasn't ideology anymore. It was risk management, because the rules had changed, and everyone now understood the rules could change again. So the diversification began, not in dramatic announcements, but in reserve reports that showed subtle shifts, in bilateral trade agreements that bypassed the dollar, in central bank gold purchases that accelerated year after year, in settlement systems being built outside the traditional architecture. China and Saudi Arabia discussing oil trades in yuan, BRICS nations exploring alternative payment rails, European strategists questioning permanent dollar dominance. These weren't revolutionary acts. They were rational responses to changed conditions. And gold sat at the center of this quiet realignment. Because gold has one characteristic no other asset possesses: perfect neutrality. It doesn't belong to any nation, doesn't depend on any government's promise, can't be printed, sanctioned, or restricted by decree. It's the oldest neutral settlement asset on Earth. And in a world where conditionality had become visible, neutrality became valuable again. Silver benefited indirectly from the same trend, not as a reserve asset, but as a hedge at the intersection of money and industry. A small position that could move violently if paper markets destabilized. By early 2026, the quiet part was ending. The accumulation phase was transitioning into something else, something louder, something the crowd would eventually notice and chase. And that's when markets become dangerous. Because the crowd always arrives late, and the late crowd creates chaos. They buy at peaks, panic at dips, turn volatility into their enemy instead of understanding it as the terrain. The smart observers weren't watching the price ticker every 5 minutes. They were watching the stress gauges. Was gold holding higher levels without collapsing back into old ranges? Yes. Was silver maintaining gains instead of giving them back within days? Increasingly, yes. Were physical market indicators showing tightness? Premiums widening? Delivery times extending? Industrial buyers securing supply early? Yes, and yes. Was the bond market acting like it believed the official narrative? That was the interesting question. Because bond markets are where truth lives. Equity markets can run on optimism, but bond markets run on math. And the math was starting to tell a different story than the press releases. So what came next? Not a prediction, but a framework for watching. If the system truly had room to maneuver, if the debt burden was manageable, if policy had real options instead of just less bad choices, then gold should relax, the insurance bid should fade, defensive assets should return to their quiet corner. But if gold kept climbing, if silver kept confirming, if physical tightness kept building, then the signal was clear. The system was choosing its path, not through announcements, but through the slow arithmetic of constrained options. And here's what made this moment different from previous scares. Previous warnings came with obvious triggers: a bank failure, a debt crisis, a market crash. This time, the warning was structural, built into the architecture itself: the debt that couldn't be reduced without pain, the currency that needed defending while supporting growth, the collateral that was becoming contested, the global trust that was fragmenting into regional blocks. These weren't problems that could be solved with one policy move. They were conditions that would define the next decade. The next surprise wouldn't look like a surprise. It would look like a routine bond auction needing a slightly higher yield, a calm banking headline hiding a liquidity gap underneath, a policy statement sounding confident while reading nervous between the lines. The truth would show first in the boring places: the funding markets, the spreads, the corners nobody checks because they lack drama. That's where systems admit what they won't say publicly. Gold and silver weren't predicting collapse. They were measuring the trade-off. They were pricing the reality that policymakers would eventually face, that every choice had costs, and the costs were growing larger while the benefits grew smaller. The warning was flashing. not with sirens, but with persistence. And those who understood how to read the signal, who watched the gauges instead of the headlines, who measured behavior instead of listening to promises, they were already positioned, not for apocalypse, but for a world where the old certainties no longer held, where neutrality mattered, where physical assets gained value not from speculation, but from the simple fact that they settled without asking permission. The system was speaking. The question was whether anyone was listening before the quiet alarm became a loud one.